What is going on, guys? My name is Gueli, and today what we're going to be talking about is a fixed index annuity. What is it, right? Whether you're trying to sell it, whether you're looking to get one, or maybe you're speaking with one of your financial professionals and they told you, hey, let's look at a fixed index annuity. Today, I'm going to be breaking it down in a very simple way. So, without further ado, let's get started. So, what is a fixed index annuity, right? A fixed index annuity is a financial contract with an insurance company. It's designed for long term savings or income for the most part. Growth is linked to a market index. So, for example, would be like the S&P 500 and principal protection against market losses. So you have protection against losses in the market, which is very great, right? So how does it grow? So like I said, it's linked to an index like the S&P 500. It's not invested directly into the market, right? Because we're giving you that principal protection, but the growth is based on that index's performance. So if the S&P 500 is doing great, then so is your investment. But if it doesn't do so well, then you're not really going to make that much money, right? Typically right now it is doing well, so you don't have to worry about that. But what's really interesting about a fixed index annuity, and it's kind of similar to an IUL, index universal life insurance policy. Sorry, I had a brain fog there, but it usually has a cap and a floor. So, in a simple way to explain this is a floor is basically the negative, right? So if let's say the floor is 0%, if the stock market crashes or if the indexes crash like back in '08, right? A lot of people lost money, it went in the negatives. They lost so much money, right? What this is saying is, listen, we're going to protect your investment. We're going to make sure the floor is zero. So if it ever goes below zero, you're not going to lose a single dollar. It's going to stay at zero. But the reason they say that is because, well, listen, we're going to give you a cap, and that cap is going to be 6%, right? So if the market's doing really well, right, the max you can make is 6% on your investment, right? You have a floor, so it's protected, but you have a cap, so it's limited. So if whatever goes above that 6%, the insurance company gets to keep. In my opinion, this is very fair because they're saying, hey, you're not going to lose a single dollar, but you are not gonna make as much money as if you were investing directly in the market. In my opinion, this is a great product for people who are very conservative, who don't really like risk. Even if you're kind of risky, it's still a safe investment. It's still great. Compounding interest really helps. But why do people get them, right? Most people get them for retirement income planning. I know a lot of people, typically in their 50s, 60s, they roll over what's in their 401k into an annuity because an annuity has so many other benefits. A fixed index annuity, per se, it has so many benefits, right? Um, but they also get them for protection from market downturns, right? Like I said, you have a floor. That floor protects you from losing money in the market. They want growth without the full market risk. Again, they don't want to lose their money. Um, and this is more so long-term money. You want long-term money. You don't want short-term money. Short-term money is never a good thing in my opinion. You never most of the time things take time. Most of the time you want an investment, you want something good, it's going to take a little bit of time. It's not going to happen overnight. Even a couple of years sometimes is still not it's not recommended, right? And then obviously peace of mind when it matters more than max returns. And what's really great about a fixed index annuity is because I'm not going to get too crazy into it, but if you have a 401k, a lot of people transfer what's in their 401k into a fixed index annuity. And I'll tell you why. In a 401k, you can lose all your money to the market. Okay, uh, 401ks, in my opinion, aren't really meant for retirement. Um, this is what I was taught. They're not really meant for retirement. They're just an investment vehicle. But typically, what happens is when you have your money in a 401k, you can lose it, right? But what also happens is if you pass away and there's money still in there, that money does not get paid out to your family. It does not, right? But when you transfer to a fixed index annuity, what happens is, let's say you transfer 250,000, right? Some people let it sit for 5 years, so that the compound interest build up, right? So typically with an annuity, people start getting income, like a 401k. Once you say, hey, I'm ready to retire, they start paying you income. With an index annuity, if you pass away and there's still money in your account, Whatever's left over is going to get paid out to your beneficiary. Your beneficiary is someone you name on your policy to receive the funds if you pass away, right? Another thing with a 401k versus annuity is a 401k, once you run out of money, you're done. You don't get paid anymore. An annuity continuously keeps paying you until you pass away. That's what's great about an annuity. There's also other benefits, but I just wanted to clear those up really quick. This is typically why people roll over their money from a 401k into a fixed index annuity. I don't really know too much about the other kinds of annuities. This is more so my specialty, fixed index. I've done a lot of research. I've helped some people with them. I think they're a great product. I'm not telling you to get them, but I'm just telling you what I recommend. The trade-off, though, obviously, safety means there's limited upside. So obviously, your investment is protected. It's safe. You're not losing a single dollar, but there's upside. We already talked about that. There's a cap, right? There's no such thing as a risk-free high return. The protection comes with trade-offs, but it's really important to understand, right? The growth is capped in a strong market in the strong market years. So that's, if the market's doing 15% and your cap is 6-7%, you're losing a lot of money there. And then money is typically locked in for a long period of time. If you say, hey, when you put money into an annuity, what happens is I don't know the specific word for it, but let's just say it's locked in. You say, listen, you need to have your money locked in with us for a specific amount of time before you can pull it all out, right? So with a fixed index annuity, let's say you put 100,000 and they say, okay, listen, we're gonna take this 100,000, but you cannot withdraw this full 100,000 or withdraw any money for the next 10 years. So within the next 10 years, you can't withdraw anything. But what you can do is you can take out income. So I actually learned this is, yes, you can't withdraw like a lump sum, right? But you can take income. And that's something you would discuss with your provider. I'm not quite sure on the rates for those, but that's something that you would discuss with your provider. Who does this make sense for? So it makes sense for people who are looking for long-term planning, retirement planning. Typically for fixed index annuities, people get them for retirement purposes. People closer to retirement. It doesn't really make too much sense for someone who's like a 20-year-old or 30-year-old, right? It doesn't really make too much sense for them. There's other vehicles for that. It's for those who look for stability, right? And money they don't need soon. This is most of the time when I'm talking about annuities is for retirement purposes. It's something that I can say for sure will guarantee you income, and you cannot outlive your income with a fixed index annuity. But sometimes it doesn't make sense for people, right? And it doesn't make sense for people who are looking for short-term goals, who want to, buy a building in the next year, or get a nice car, get a house in a year, right? It doesn't make sense for these short-term goals, right? It's not for people who are seeking aggressive growth, right? You like I said, you have a cap. Whatever you make is capped. So if it's at 6-7%, you can't exceed 6 or 7%, whichever it is. But like I said, your investment is protected. It's people who need liquidity, right? It's not meant for these people. And also it's for anyone who doesn't understand it. A lot of people, most of the time, by the way, this is a tip out here. A fixed index annuity is someone with a life insurance license can sell. So if you are life insurance licensed, you can sell fixed index annuities. But what I will say is a lot of people don't understand what these products are, and they misrepresent them. They tell them in a different way what they are. Just like a index universal life insurance policy, even whole life and term. People misexplain them. They don't explain them the right way to people, and they don't understand what they really have, right? This isn't something that you should get if you don't fully understand it. This is a great product, but it's also a limited product. But it's also something that can greatly help you in the future depending on what you're looking for. It's not for everybody, but it can be useful, okay? But that was a really quick video. The big takeaway really is, the fixed index annuity is designed to balance protection, growth for long-term planning, but it's not used to maximize returns. So like I said, most people usually get these for retirement purposes. That's probably, in my opinion, one of the best ways to go. But I hope this video helped. If you found anything of what I said valuable, please like, comment, and subscribe, and we'll go from there. Well, listen, guys, I hope you have a great rest of your day, and I'll see you later. Bye-bye.